Hello, everyone. Welcome and thank you for joining this Centurion Apartment REIT Advisor Zoom webinar featuring Greg Romundt, President of Centurion Asset Management. My name is Paul Meir, Head of Sales, and I will serve as moderator for this webinar. The Centurion Apartment REIT now has over $7.3 billion in AUM with an A-class rate of return since its 2009 inception of over 12.6% a year and an F-class return of 13.7% a year since its 2013 inception. The REIT is the largest private apartment REIT in Canada and its second largest apartment REIT, public or private. Greg, thank you as always for your participation in this webinar, and congrats again on navigating what was somewhat of a tricky 2023. So to begin, would you like to share some brief performance highlights of the Centurion Apartment REIT from 2023?
Sure. So I'm happy to go through some of these numbers, really quite consistent with what we've been messaging since last year, or consistently through last year and early parts of this year. Growth in total same-store operating revenue was about 7.7%, well above the rate of inflation. Growth in property operating revenue just short of 26%, so really big number. Growth in NOI grew 27.1%. Same-store NOIs up almost 11%. Same-store NOI margin 65%, so that's up a little from the prior year as well. Overall portfolio occupancy about 95.5%, but the stabilized properties, so we have the newer properties that are in stabilization. The stabilized properties were 98.4%, so really consistently tight everywhere, except the things that are leaking up, and even though up pretty quickly. The proportion of stabilized properties is 81%. And some other things that people would be interested in are the weighted average mortgage liability term. So this is mortgages we borrowed for the portfolio, so it's long term, 6.2 years at about 3.29%. So very low rate of interest and for long periods of time. Debt on the book today, call it 48% debt to gross book value, and a market rent gap that's just short of 10%.
I know we're going to revisit that rent to market rent gap, but before we do, could you perhaps characterize the Canadian multifamily landscape of the past year and highlight some of Centurion's key acquisitions?
Well, it's been a quieter year than in most years, as and again, this is consistent with what we've been saying. As the markets have been digesting the Bank of Canada rate hikes, and many players are still waiting with dry powder to see a move to cut rates as a signal that the next phase for the real estate market is coming for the economy in general. But the U.S. market is seeing earlier signs of this move of capital, which is happening quite recently. Blackstone bought Tricon, which is it's a Canadian firm, but mostly U.S. portfolio. And Blackstone also bought, that was for $3.5 billion US in January. And Blackstone just bought another Air Communities for $10 billion. So, it's interesting that the activity is starting to pick up, but mostly on the US side. I think we'll start to see this flow through into Canada, but we probably need to get that first rate cut.
And Greg, would it be fair to say that the acquisitions that we made in 2023, whether it's in Kelowna, Dartmouth, Gatineau, Calgary, essentially it's building already on our existing presence in those areas?
I think so. I mean, it's hard for us to get into new areas unless we can do something that's we think is going to be scalable. So a lot of what we did in 2023 was either tuck-ins, so meaning we already own something very close and it was just a good fit for us, or it was something we priorly committed to, or working with a developer or something like that. So it was very, very much a strategic year, but it's relatively speaking busier than you'd think in a year where most people would say it'd be quiet. I mean, we made 11 acquisitions and added almost 1,650 units over the course of the year, which is almost all of it new as well. So, I think that's pretty good for what I expected to be a pretty quiet year.
And how does then the acquisitions pipeline look for this year? Again, any particular areas you'd like to focus on?
I don't think there's a particular area that we're focusing on. We've always been very opportunistic. So it's where we see opportunity, and it's not just um, where we think rents are going. It's the price and the relative yields, the total growth potential, but it's also where deals come. So, today our focus, if I had a choice, is still BC, Ontario and Quebec. And I really want to be a bull, and I am a bull on Alberta, because, I really like the energy sector, but it's very hard to be growing there strongly, making acquisitions when we have a federal government that's so, uncooperative in allowing that province to flourish. So, we like it. We're there. I'd really like to grow there, but it's tough for me to allocate capital there right now, or more capital.
One thing can be said is Centurion definitely has a very well diversified portfolio right across the country. Turning to the mortgage book, how did it do last year? How are we positioning it, and any concerns with any defaults at all?
It's, you know, it's done pretty well. But we really were on top of this book, and in COVID, I mean, I messaged this for a while, but in COVID, we really made the conscious decision to rotate from mortgages towards equity, right? So owning the apartment buildings. So we knew going into an inflationary period that was going to be the smarter move. And it ended up being so. I mean, so one of the things that gave me pause at the time, and certainly is a constraint today, was not only that construction inflation. So we have costs, right? So inflation in costs, and that was going to make a number of transactions, I think, harder to complete. And certainly, we've seen with interest rates increasing, a lot of those developers have not only had to bear with higher costs, but they've also had the higher interest rates make it harder for anyone to be able to qualify and afford. So they're not getting pre-sales. So our timing was pretty good on this, and as a result, we have very few loans where we've got to work. We're always working some. As of now, there's nothing we anticipate we're gonna have to take a principal loss on. But this is a business where if you're charging the kind of rates that we are, you're always having to do a little bit of work. But it's pretty small given the size of the balance sheet.
So now, turning to 2024, how do the prospects look for Centurion, particularly in the context of cap rates and rent growth in the country?
So I really believe the next move from the Bank of Canada will be for a cut, and that this will likely spur more activity, and likely cap rate stability, I think, is where we're at. Rent growth, as you can see from our market rent chart, has absolutely exploded. And even though the government is introducing, or trying to introduce some incentives to build, and they're also reducing the number of new immigrants coming in. I mean, we're moving from a pace that at one point in the last little bit was running at a 1.75 million person per year. And the last estimates I've seen we're still going to be north of 1 million per year, and construction is declining. So even condo sales are down to 15-year lows. Now, why does that matter? Because if if a developer can't get pre-sales of construction units, they can't get the construction financing, so nothing actually comes out of the ground. And we've seen that construction is actually declining and making the supply demand gap even worse than it was 6 months ago. So think of it this way: if your house is burning and you reduce the 1.75 million gallons of gas you were throwing on the fire to only 1 million gallons of hot gas while you're throwing 200,000 gallons of water on it at the same time, you still have a really big fire. And, I don't mean to make light of it, but, just to give you a metaphor for, how we think about this, that the supply and demand are so dramatically unbalanced, and even with these recent changes on both trying to create supply and trying to reduce demand are actually gonna make this worse, not better.
Yeah, no, you're so right. I mean, now looking at this particular chart again is, I guess this would underpin how you anticipate Centurion will be able to achieve its solid return, not even this year, but going forward.
Yeah. So, really what we saw in our rent gap is, this number absolutely exploded. And it's not because we're not realizing. So when I look back in 2023, we realized approximately $16 million in increased rents on on the portfolio. So when you think about what that is worth, that's worth, I'd call it a roughly 4.25, 4.5 cap rate, just short of $400 million of value create just from realizations. Now that doesn't include the the potential or other rent decreases. When you think about this, we went from at year end was just around 35 million, and at Q1, that's why I want to give it to you. That's gone out to 41. So if you think about it, what would it have been if we hadn't realized any of these? Had any realizations? We'd be at 57. So let's just give you a sense of how short the market is of housing, and how strongly rents are continuing to move pretty much across the country.
Well, so then, Greg, what would you say to the advisor who completely subscribes to obviously the compelling investment thesis of Canadian multi-res, yet chooses to invest in public REITs?
Like, I've never said we have to be all of someone's allocation, or privates have to be all of someone's allocation. I think there's room for both. There's a place for both in a portfolio. You don't have to be all or nothing on either side. But I do think, and this, we've been consistent in saying this, I think we satisfy somewhat of a different requirement for diversification, because public REITs tend to move around with a lot more volatility. But Centurion has been a much less volatile anchor for an apartment sector allocation, and delivering similar, if not higher, rates of return than our comparable set. And we publish this data at about a third of the volatility. So, if you're trying to trade in and out, maybe there's a place for trying to pick bottoms and tops. But if you're in this, like I think most investors are, for the very long haul, like, why would you just take the extra volatility if you didn't have to? But again, okay, I think there's room for both.
Fair enough. Well said. Okay, this might be a little bit of an unfair question just because of the scope of what what I'm leading to. But over the past year, as we've all seen, various levels of government have announced programs and measures to deal with Canada's housing crisis. Would you care to assess them, or can you? And do you think that they're going to help to substantially alleviate the problem?
Well, this is a really lengthy answer. I am considering writing a white paper on it, because so much has been announced, or at least talked about, right? However, I do think that a number of things proposed are at least steps in the right direction. However, there's been things that are in the wrong direction. The increase in capital gains, I really think, is a step in the wrong direction, because what Canada needs in order to address the housing shortage is capital formation on a scale never before seen in the country. And increasing taxes on investment is quite likely to be a step back. I mean, I've talked about that over 10 years, the housing industry, to get us back to affordable, we need $3 to $4 trillion of housing investment. And if a trillion of that is apartments, right? So roughly a third, which is balances the population for owned versus rental, assuming no change in mix. There's about $1 trillion of rental that needs to be built, requiring roughly 400 billion of equity, 350, 400, whatever. So the entire capital, the market value of the public apartment REITs in Canada is give or take 20 billion. So we'd need to multiply the amount of capital in this space by a factor of 20 to meet that demand over 10 years. And that's just never going to happen. The other things we have to keep in mind is even if the land was given away free, we don't have the labor capacity to build the housing that's required. So, I like to compare the housing market, and I've used this analogy many times, that the housing market's like a car. It requires 4 wheels, engine, steering wheel, and hundreds of other components to work. But if you're missing just one tire, you're really not going to go very far. And so this is really one of the problems that we have. We can talk about tweaking this policy and talking about tweaking this policy, and yes, some of it's going to help, but you really need to remove this problem. You have to address all of the boundary issues, and we really haven't got there. And even if we did, immigration inflows are still too high relative to the ability of the market to respond. Providing more loan capacity, which they've talked about and they've announced, is good, but the amounts announced are really a tiny fraction of the capital that, as I've said, is in the trillions of dollars. In the budget, they announced taking the capital cost allowance to 10%. Yeah, that's great, but if you find it hard to get the equity capital to build because of increased tax load, you're really neutering the potential benefit of that, say, CCA allowance. And who's going to use that CCA allowance? It's not going to be the developers. It's going to be the vehicles like the large investment funds, right? Like ourselves, and or other large institutions. So, but if you increase taxes, you're kind of offsetting the benefit here. So maybe it blends some of the impact. The HST announcement was a big benefit, which they did. That was late last year. They announced removing HST, or the GST component. A lot of provinces followed suit. But again, builders are still constrained by high cost of construction financing and insufficient capital formation and that labor shortage. So, look, I'm glad that they're doing something, but it, feels to me certainly more that these are announcements with the desire for political support, or, they're more talking points, which I think is more common out of this government, that talk, but not actually deliver much in terms of effective policy.
Yeah, no, I would agree. I mean, government, you could say charitably, too little, too late. And yeah, as you have been saying for years, is this supply-demand imbalance, whether it's in housing or specifically in multi-res, is intractable, persistent for the foreseeable future. So one of the solutions then everybody's been talking about, or a great many people have been talking about, is, hey, we have these vacant office buildings. Why don't we just take the vacant office buildings in whatever metropolitan center and convert them into residential? Is this the panacea? Is this a solution?
I mean, I'm laughing because I get asked this question a few times a week, and it's the same answer. So I'm actually in the process of writing a paper on this because I just get asked so often. Suffice to say, this just won't work in the vast majority of cases, because the product that you build, the location of these buildings, if you think they're downtown, the cost of conversion are so high, and you're really converting the asset into something that's really not an attractive place to live for most people. No windows, no, individual ability to set their temperatures, very odd shaped units. So there's a very, very edge case where it's going to work in a few situations, possibly. My view is most of those obsolete office towers just need to come taken down and something brand new gets built.
Yeah, I must say I've enjoyed when you've been asked that question before. You've really gone into the engineering specifics, and it's really enlightening as to how many obstacles there are, unfortunately, in terms of taking an office building and converting it to multi-res. So, that's looking forward to that in that white paper that you'll be writing. Okay, of course, no webinar would be complete without your thoughts about the global macro landscape. I mean, how are you making sense of this world right now? And then maybe sort of transitioning into how that impacts Canadian multi-res. But first, global landscape.
Look, I think all central banks desperately want to cut. If you're a tech company, you're just fine. So you got no debt. Um, you know, it's fine, and that was the story of 2023. Certainly, the last 12 months, where tech has done, or AI has done extraordinarily well, but most of the rest of the economy has really struggled, right? Particularly individuals, and I've said for quite a long time that with the U.S. government at its current debt levels, the same thing with Canada, neither government can afford these rates of interest, right? And that's a real problem. Nor can people, because we have so many people who've leveraged up to buy their houses or afford houses, and interest rates have gone up dramatically, and we've got these mortgages that are rolling over, and people can't afford to pay them. And you can see this is already, the market's not rolling over, so to speak, not yet. But the issue is, and you can see this in the pre-sales data, pre-sales have absolutely collapsed, right? The transaction volumes in the residential, single family home, condo market have collapsed because people can't get financing. So can't build it, can't finance it, makes the supply situation worse. And the governments have, particularly in the US, have very, very short duration debts. So keeping rates at these levels are really going to choke down. And as you know, I have held this kind of contrarian view for a very long period of time, that when rates were low, people said, well, that was inflationary. And I said, no. You have to understand that when you move to high levels of debt, low levels of interest rates allow construction and production. So, and that keeps a lid on prices. So when we moved to COVID, now all they did was just print a ton of money. So now we had, then it's not an interest rate problem. It's down too much money sloshing around the system, which was not a really good investment. And then now we move to these secular, tailwinds behind inflation. So we got war in Ukraine and the Middle East, right? Putting up energy prices, supply chains at risk. We've got deglobalization, right? We have de-dollarization because the Western powers have moved to seize Russian central bank assets, which undermines confidence in the dollar. So you're seeing this in terms of commodities prices, and particularly gold, which has just had an explosive move to the top side, and apparently rumors driven much by China. So I think one of the real challenges are going to be, and I've been consistent in saying this for the last 3 years now, that we've got a decade ahead of inflationary pressures, and we need to get back down to, I don't think we're going back to zero rates. I don't think so. But I do think that we're going back to negative real rates, which means that interest rates will come off, but inflation will remain high. I don't know how they figure out how to message that, because there really is no other way out. If you look at what happened in the period after World War II, during World War II and after, there was yield curve control, which means when you had 8, 9, 10% inflation, they pegged the 10-year bond at 2. So it was financial repression. I believe that given where government debt rates are and social obligations, the only way out is inflation and financial repression. But we will see interest rate cuts this year because we have to, not just the economy, but for the governments themselves. So I believe firmly that they want to cut, and they're just looking for a window to do so.
Wow, that is a great synopsis. And then, sort of lastly, Canadian multifamily within that context, strong as ever?
And so, while Canada has some serious economic challenges, I mean, we've got declining productivity, we've got increase in tax rate. Like Canada, productivity wise, hasn't seen any positive productivity in 8 years. Now I can draw a correlation there. Not that hard to figure out. But this is a real issue. So GDP per person or GDP per capita has been declining. So we're already in a recession, right? I do think that the multifamily asset class is, as you can see from some of the results we've talked about and the tailwinds we've talked about. I think that we have a good 2024 and beyond to look forward to. And quite frankly, I think multifamily is the most obvious business opportunity in Canada to me, my opinion. Nothing else comes even close or remotely close for the obvious business case, supply demand imbalance, inflationary pressures, all this, the focus of government incentives, and certainly on a risk reward basis. So yeah, I'm quite optimistic on the look forward for our business. I mean, everything is pointing in the right direction.
Wow, Greg, we touched a lot of bases in this webinar. Thank you so much. That was really insightful and greatly appreciated. And so to you, the investment advisor, on behalf of Greg and your sales team, we would like to thank you for your continued support and time. We very much appreciate it. Should you have any follow-up questions, please do not hesitate to contact myself or your wholesaling team. Once again, thank you so much for joining us, and have a great day.